In the late 70s, the United States experienced what was called a second mountain of inflation. From 1978 to 1980, inflation rates in the United States surged to new highs as a continuation of the inflationary pressures that had been building throughout the decade. Several factors contributed to this second wave of inflation. Oil price shocks from the OPEC oil embargo of 73 and 74, wage price spirals which fanned the flame to more inflation because workers demanded higher wages to keep up with inflation, and then businesses needed to raise prices to cover the increased labor costs. A third cause of inflation was monetary policy. The Fed pursued a policy of monetary accommodation in the early 1970s, which led to an expansion of the money supply and higher inflation. And finally, supply constraints led to shortages and higher prices for many goods. The combination of these factors led to a rapid acceleration of inflation in the late 70s and early 80s. In response, the Fed Reserve Chairman Paul Volcker implemented tight monetary policies, raising interest rates to combat inflation. This policy, while effective in reducing inflation, also contributed to a period of economic recession in the early 80s. Could this scenario happen again? Well, take a look at this chart for some insight. Inflation today is influenced by factors such as supply chain disruptions, increased consumer demand, labor shortages, rising wages, increased consumer demand, and the results of massive monetary stimulus from the COVID pandemic. With the exception of the oil embargo, today's factors that are influencing inflationary pressures sound pretty similar to the factors we experienced in the 1970s. Since the Fed turned dovish in December, financial conditions have eased dramatically, with the S&P 500 reaching all-time highs, credit spreads tightening, IPO activity picking up, and mergers and acquisitions activity picking up as well. As a result, consumer spending is currently getting a strong boost from record high stock prices, high home prices, and high cash flows for investors in fixed income like bonds or bank CDs. The bottom line is that a dovish Fed, one who continues to lower interest rates and gives the green light to investors too soon, could result in a second mountain of inflation. Let this chart speak for itself. Where do you think inflation is headed in the next year? As always, we'll keep our eye on the economic conditions and manage your portfolio accordingly. Thank you for the trust that you've placed in our team.